Investing for Beginners, Lesson 6, Stock Taxes. Paying taxes on a profit. When paying taxes on a profit, you need to know the definition of capital gains and how it applies to paying taxes. In Lesson 2, we mentioned the two types of investors, short and long term. Capital gains taxes are different for the two types of investors. What are capital gains? Capital gains are simply the profit, which is the difference between the purchase price and the selling price of a stock. In other words, the selling price minus the purchase price equals profit. Capital gains taxes. If the price of a stock you purchased has increased, it would be a profit and you would pay taxes on just the profit amount when filing your yearly tax return. Taxes are paid to both the federal and state governments. Some states do not have state income taxes, so capital gains taxes are not charged. Short-term taxes means investor pays higher taxes for selling a stock held less than 1 year. Federal tax, 25% or depends on your ordinary income tax bracket. State tax varies depending on the state income tax. For example, my state of Massachusetts, short-term capital gains is 12%. So I would pay 25% federal tax and state tax of 12% for a total of 37%. Long-term taxes means investor pays less tax when holding a stock for more than a year. Federal long-term capital gains taxes in 2013. Long-term capital gains taxes depends on your annual salary. What you owe once selling a stock with a profit. For a single taxpayer who earns less than $36,250 and a married investor filing jointly who earns $72,500 or less pay no capital gains taxes. For a single taxpayer who earns less than $200,000 and a married investor filing jointly earning less than $250,000, capital gains are 15%. Others are looking at paying higher capital gains taxes along with the new Medicare surtax. For a single taxpayer who earns more than $200,000 and a married investor filing jointly earning more than $250,000, capital gains are 15% plus the Medicare surtax of 3.8% is a total of 18.8%. For a single taxpayer who earns more than $400,000 and a married investor filing jointly earning more than $450,000, capital gains are 20% plus the Medicare surtax of 3.8% is a total of 23.8%. State long-term capital gains taxes. Long-term capital gains taxes charged depends on your state income tax rate. For example, long-term capital gains taxes in my state of Massachusetts is 5.3%. Total long-term capital gains taxes. It depends on how much you earn in 1 year. The total percentage is federal capital gains plus state capital gains if your state charges state income tax. For example, in my state of Massachusetts, for long-term capital gains, I would pay 15% federal tax plus 5.3% state tax for a total of 20.3%. In summary, short-term capital gains. Profits from stocks held for less than 1 year are subject to ordinary income tax rates. Long-term capital gains. Capital gains tax rates are lower to encourage investors to hold on to stocks longer so companies can use stock money to grow the business with either new product designs or an acquisition of another company. Benefit of holding a stock. If you hold stocks for more than 1 year before selling them, any profit is subject to capital gains tax rates, which are lower than ordinary income tax rates. As you can see on slide, the table summarizes how long-term capital gains are charged depending on your ordinary income if you are single or married. Thank you for participating in Stock Taxes video. Please continue to the next video.